We're having fun today, but we are talking about some serious business here. We're talking about risk versus reward and what investment type might be best for you. George, let's talk about investment types and let's go least risky to most risky, I think.
Sure. So essentially, there are four different types of investments when it comes to commercial real estate. You have your core plus, value add, and opportunistic.
Yep.
So those are in order from the least risky to the most risky. Now, core assets, as an explanation, typically are institutional grade assets and institutional investors. They're Class A assets, and they typically give a return from 10% or less overall. Now, the reason why investors like them is because they tend to have a little bit more of a stable cash flow. Class A assets tend to be in demand with tenants, so you have less vacancy risk, and you have a more stable income stream going throughout the entire process.
Yep.
So with that in mind, then you start looking at your core plus assets.
Okay.
Now, core plus, again, strong areas, strong neighborhoods. Maybe they're Class B buildings, not as nice as the others. May need a little bit of improvement, but no real capital expenditures into the property. With those type of assets, you're looking at generally a 10 to 14% IRR or return for an investment hold time frame.
Okay.
Value add.
Okay.
Now, here's where you're looking at assets that actually are A, B, potentially even C neighborhoods. And
our specialty.
Our specialty, yes. And with the value add, though, you can expect to have a return between 14 and 20%. With that in mind, you're also going to have to put in a lot more into capital improvements. That's where the value add is. It could also be potentially a repositioning of an asset as well. But to do that, again, you need a lot of capital improvements to do that. Whether it might be, the hot thing right now is changing office over into multifamily. So you're repositioning that asset, or hotels into multifamily for short-term rentals.
Yep. So
lastly, you have opportunistic. These are properties that have really pretty much been at the end of their life. Whether it's changed, it may have been in a medical corridor that the area's changed and no longer in need, so you want to reposition it or potentially even tear down that asset and then redevelop it. A lot of developments are also called opportunistic because you have to put essentially 100% of the development costs back into the building or back into the land. The nice part, though, is if you do it right, they return 20% or higher IRRs. Some developers even target 40, 50% returns, which is great, but again, high risk.
High risk, yeah.
And because something may happen, downturn in the economy may happen, a major downturn, and that could actually leave your building vacant. You can lose it all because you have no income coming in because it is opportunistic and you're really repositioning that asset. So really what you want to do is find out what you're looking to accomplish and determine whether or not that meets your investment criteria with the risks that you want. Is it asset preservation, cash flow, returns? All that is a factor. And then if you speak with a good agent, they can actually help advise you a little bit on what is the best asset class for what you're trying to accomplish during your investment career.
Beautiful. Thank you very much, George. This is great information. What I want to pick your brain a little bit here. We've got a few minutes, but on the core assets right now, are you seeing many of those coming on the market still?
They are trading. You normally don't see a lot of the core assets on market.
Right.
A lot of times they're traded between institutional clientele back and forth. They may put some on the market. What we are seeing, and the nice part is, even during a downturn in the economy, core assets typically are still in demand because it is a Class A asset, newer construction in a prime area. That's very limited, as opposed to a B, which you can expand the area, and there's a lot more that could potentially happen. And C, of course, is your
Well, we like
mom and pops.
little hair on it. We
Exactly.
like to dig in and change it. But you're probably seeing more of that coming on right now, right?
We're seeing combination B and C's right now. That's the majority of what we're seeing coming on the marketplace. I think we're going to see a little bit more of the core plus assets, like the C assets, B and C assets come on the market as the economy softens a little bit more. People are going to be forced to sell because the income stream is going to be affected. So we're going to see that come on the market, I think, a little bit more so in the coming quarter, 2 quarters coming in. And I think by then, interest rate hikes are expected to stop.
Yeah, slow down. Yeah.
Slow down, if not stop, hopefully in
Yeah.
2 quarters, and then we're going to see a little bit more stabilization in that.
Okay. All right. Thank you, George.
Okay, thank you.
Now, if you have any questions, don't hesitate to reach out to George. I'm going to put his information down below. And if you haven't done so, make sure you give us a like and make sure you subscribe, please.